Hello guys, welcome back. Good to see you here again for the third event of the Stardust Startup Program. That's gonna be about funding, about financing, tax and accounting. And it's gonna be a workshop, kind of. So be ready to move, to ask questions, to get the best and the maximum that you can get from an event like this. So just to come back to what Stardust is and why we're here. Actually, our aim is to promote entrepreneurship in DTU for DTU students. And it's not just promoting, but it's also a way, and we try to figure out the best possible way to push the startups that are born, that are growing up in DTU. And this is one of the events where we are trying to give as much as advice as we can, thanks to our mentors, our speakers. So today I want to present and introduce Nikolai Nielsen. Is the pronunciation all right? Okay. So you forgot my middle name? I don't know that. Okay. And so enjoy the event. And remember that from the next semester we will be a Skylab DTU in 373. And we hope to see you all again there, even if the program will be over. And enjoy the workshop and keep working on your startups. Thanks.
My name is Nikolai. I'm mostly an entrepreneur. I'll give a very, very brief introduction to my background, but this shouldn't be about me, but more about funding. And I've been allocated more or less 1.5 hours in total. So we'll try to do some Q&A, some workshop-like thing. And I think you also had my presentation beforehand, right? You had access to that. Because the first thing I would like to do before giving the more formal presentation is actually just hear very, very brief about what is your business, what is your idea about, both in terms of stage, where are you from idea to having a product or customers, but also what kind of industry are you. Just very, very brief from the 5-6 groups. Then we take my formal presentation, and then hopefully we have these 20 minutes at the end basically to discuss and say, well, based upon what you hear now, who do you think are the most likely investor? And should you actually go investors? Because there's actually a good reason why you should forget about investors, but that's another point. So if we take the very, very quick one, so you're sitting together, I guess that you are in the mobile thing. Now, what is you about? What's your business about? Or idea?
Yeah, we're actually we're working within 3D printing.
Yeah.
So right now we have it's like a 3D print shop where people can buy 3D printed stuff on the internet. So
yeah.
Both our things that we make and then their own things as well.
Okay.
So print service.
3D printer shop. Yeah.
We're kind of trying to move from there as well to a product concept. So.
Yeah. So going from a service to a more product concept, yeah.
No, not really. It's going to be more service.
Okay.
We're just about to develop the concept. Yeah.
Cool. You?
I'm part of Ubri, and we do monitoring of storing conditions, which could be vaccine storage.
Yeah.
So we monitor temperature.
So sensors for that.
Yeah, exactly.
Okay. Cool. Building your own sensors or taking existing technology and wrapping it?
Kind of both. We're building our own system with other sensors from producers, but we're building the system from scratch. Basically.
Okay.
The intelligence, hardware, software, the backend server, whatever.
Yeah. And you?
Idea, so very simple idea. It's a trash can made of cardboard.
Trash can made
out of cardboard.
Yeah. I think it's on. It's not out to speak.
Yeah, so trash can made out of cardboard is
Yeah.
foldable, and then when you can just put it up everywhere, and
Yeah.
then it's you have to throw it out after use. So we have this advertisement on the side of it.
Yeah.
Yeah. That's the idea. It's all.
Understood? Yeah.
Hello?
Just talking to that. I think it's recorded even though it's not in the
Okay.
speakers. Yeah.
The people I work together with, we want to use the fact that in medical research there's a lot of research correlating psychosomatic factors together with physical symptoms and illnesses, such as cancer, for instance.
Yeah.
And we want to take this knowledge and make a computer system that can apply it on people and see if that is somehow makes it possible to use this knowledge for something.
Okay.
Yes, and I'm part of SL Tech, and we are building a sunlight lamp, which can simulate the sunlight perfectly. And that has many appliances.
So to emulate how things are affected by sunlight, or
no, the what do you call that? The
so
visual
working environment.
effects. Yeah. that's
Okay.
what
Yeah.
Work. Yeah. And also as a light saving, to save electricity.
Yeah.
We are two guys, and we're working on an app to support psychological courses of treatment.
Have to speak up a little bit. I can't hear you.
Yeah, we're doing an app to support psychological courses of treatment.
Yeah.
Where we connect the clients with each other. They can interact with each other, and also do different kind of homework that the psychologists hand out to them, and improve and see what kind of things work for them.
Yeah.
I mean, you.
Oh, you're in that group? Yeah. Are we done?
And we generate self-sufficient energy for households through the hydrogen technology. So basically, we use the surplus of energy that the house doesn't need to produce and generate hydrogen, storage hydrogen, and with the most efficient, like emergent technologies, fuel cell technologies, we provide energy for households without any kind of emission.
Yeah. Cool. Cool. So the goal is actually that you get an overview. And I'll say an overview because when we're covering all that, we will not go into detail with venture capital or business angel, whatever. We simply can't do that now. So since you already have the slides, I'll go through them. We will most likely not go to the end. So it's very important that you just ask questions. That's actually why you got the slides beforehand, to say, well, how does that apply for what I'm doing right now? Because since I'm not that detailed into your businesses, I can't ask those questions on my own. You have to ask me. Cool? I think the disclaimer here is very important. That is, this is taken from a Danish perspective. And despite everything you read, startup funding is still quite local. So if you have a startup in Denmark, located in Denmark with Danish people, or just you're located here, the chance that you get investors from Denmark is 100 times higher than you'll get one from Sweden or Germany. That's just how it works. And that's actually good reasons for that in terms of the early startups, you invest in people you trust. Therefore, you most likely invest in people that are close to you or you know either directly or indirectly. So if you want to have startup financing for Silicon Valley, you have to move your company to Silicon Valley. You have to live there most likely, or a big part of the company will be there. So I see way too many startups that spend hours and days and weeks on going up on Sand Hill Road, which is a very nice area in Palo Alto, and talk to very polite VCs. But if you think your company will be in Denmark or Europe, you will not get funding from these early stage VCs. They are not allowed to invest in European companies, period. Actually, they will not invest outside a radius of 50 kilometers from Palo Alto. So, just as you know. So what we discussed today will most likely be about how it is from a Danish perspective. We get the overview. If we have time, we'll go. I just need to find out how the pointer is here. Fuck, it doesn't work. The red light? No red light? Okay. Okay. So focus will be on overview, and if we have time, also what kind of material that you need. But that is secondary. I think the most important thing you should have is understand how the different kind of investors think and why you most likely should not spend time on VCs right now. Anyone of you out chasing investors right now? Like talking to potential investors? Yes,
Chasing money in general, like.
Yeah, we always are. Yeah, I know that. If someone wants to give me money, yeah.
No,
yeah.
but it's more like, okay, some of us in here doing hardware startups,
Yeah.
requiring some initial funding in some way,
Yeah.
either by friends, fools, and family.
Yeah.
Just to get it started, right?
Yeah, that's true. That's true. My own background is one. It's really. Isn't it this one that should press if I want to read the beam?
Probably.
Oh, maybe now it works.
It doesn't work on the screen.
Yeah, but doesn't work down here. Okay. You can't see it. One consumer hardware, four IT, one medtech. So that's my background from it. So it's mostly the companies I raised money for are mostly in the category high risk, high reward, meaning it's not for service companies. But also what I can hear, most of your companies will also be in the high risk, high reward category. And again, that is my perspective. If you're going to raise money from a 7-Eleven, which is no problem, that could be great business, most likely you'll not chase the same investors like those. Got it? Okay, so when we talk about financing of startups, you have to realize that different startups are very, very different seen from an investor perspective. Because investors are really concerned about what's the risk, because we all know there's high risk involved here. And just imagine 3 different startups. One could be a service business like a restaurant, or a medicine company, a pharmaceutical company, or a consumer IT company. Both the types of risk and the amount of risk are extremely different. And the ones who are going to invest in this are for sure not going to invest in that, I can guarantee you. Even within the same fund, you can come to the same VC fund. And these two are 2 separate groups of people, because you try to have something that you really understand. So just have to realize that seen from even those startups that you have, seen from an investor perspective, they are so, so different. There was something about reusable trash cans, right? Compare that to some green energy over here, 2 very, very different risk factors. Most likely the technical risk in your project is not that big, but the commercial risk is very high, unlike that one, most likely. So I think the 2 axes that you should be concerned about is, the one is scalability, and that is how big can it be. And how big it can be is nothing again, and it's not the same as how big the market is. Because, for example, the restaurant market is a huge market, right? It's a huge market. But most likely, even if you make the best restaurant, you will not be big. Why is it hard to scale a restaurant to become a chain big one? Why is it hard? And it is? Yeah, you need people. Everything that needs people is hard to scale. And especially if you combine it also with capital expenditure. Just imagine for each new restaurant you will open, the cash up front in interior, whatever, is very hard. So in general, companies like those are not easy to scale. It's not the same as it's not good business. My sister and brother-in-law is having an import-export company to Greenland. Is it over here? Yes. Can you make good living out of that? Yes, you can. And then the total opposite is, I think the most extreme is drug research, right? What is really the chance that something you see in the lab become a drug 15 years later? 0. whatever %. So, but if it becomes big, then it will become really, really, really big. So the one axis is scalability. And the other one is, of course, risk. I'll not go too in detail into that because I think it's quite obvious that even that is a lousy business, restaurant business, whatever, most service businesses is relatively low risk compared to that. Because you start, most likely you take a proven business model, over here. How many apps are there? For each Angry Bird, there's what? 1 million lousy birds, right? So relatively low risk, relatively high risk. So I think, and that's why I said the disclaimer is that the examples I will give today is based on my examples over here, who's basically high risk, high reward scenarios. And the investors you'll be looking for are very different down here. Does it make sense? And of course, over time, you will hope that you can lower the risk but keeping the upside. In real life, what happens is you lower the risk, but actually the market becomes much smaller, so you often end down here. But that's another story. But think of that. So the first question you should ask yourself, do you have something that can become really, really big? And if it's someone that involves a lot of people or capital expenditure, you'll really need to find good analogs for convincing people why it should become that big. And then, have you all read the news every once in a while saying banks will not lend startups money? You see that in newspapers quite often. Why do you think banks will not lend money to startups?
High risk.
Yeah. What's the business model of a bank? Yeah.
Well, that you earn money in return and put your money into the bank, and they're able to lend that out to other people.
Yeah, they will get the money right now from the national bank for 0.5% or something like that, and lend it to you at 6%. But just imagine the upside of a bank. Even if your company becomes the next Skype, they will not get any upside, right? They will still only get the margin. Actually, the margin will be smaller because you go to the bank and say, now we're successful, we want to pay a lower interest rate. So by default, a bank will not lend money to high risk, high reward companies. Why should they? So a bank should lend money to low risk projects because that's not part of the upside. The alternative would be that they go to you and said, well, I think most of my startups, the fair interest rate will be something between 25 to 50% per year in interest. And for yours, much even higher. If it's really on the really stage from have an idea, I think the annual interest rate should be plus 50%. What will happen? Would any entrepreneur borrow money? No. So that's why I'm saying, unless you have something that's relatively low risk, don't go to banks. And most startups are not low risk, and banks don't understand IP, stuff like that. So which startups will bank lend money to? It's hard to say. Something if the scrap value, if that 3D printer you want to buy can actually be resold at a given value, most likely it can't, right? Because what it's really worth. Maybe if you want to make a service company where you need to lease or buy 5 company trucks because they know that this is a standard commodity they can resell. But if you go to the bank and say, I want to borrow 500,000 kroner for R&D, they will not lend you money. They will most likely not lend money for a 3D printer or from research in whatever. And thank God they shouldn't. That's at least my opinion. So I think it's quite normal that banks will not lend you money. Of course, if you go to the bank and said, I have a degree from DTU, I'm starting this company, I need a credit line of 50,000 kroner. Yes, they will most likely lend you money, but they're not lending your company money. They're looking at you and said, you're young, you have a degree, you'll be able to repay it. Does that make sense? So I'm just saying, for most startups, especially the ones you're in, going to banks early on will be a waste of your time. And it should be that way. That's at least my opinion. But they could be good source for the small cash initially where you say, well, I'm here, I just graduated. We are 3 people that want to work on this product the next 6 months. And if we can't get any traction, we'll take a real job. Then you can go to your bank and say, I always paid my debt. Can you borrow me 50,000 in a credit line? And I think they will say yes. But that's not because of your company. That's because you are who you are. So they're down here. And actually they are something when you have cash flow, when you're up and running, when you have customers, then you can go to the bank and have a real credit line. But don't expect that now. So, banks are not investors because banks are credit givers. They don't take a share of the company. Now we move into investors, who are those who are taking a share of your company. You all know the difference between equity and debt, right? So egenkapital, fremmedkapital? Just now. Even though we don't understand, but just say yes. I think the biggest mistake I had from when I started my first company was that I actually thought that coming out of CBS, I could take a business idea that is formulated in a business plan and get investors. And unless, there are of course rare circumstances where that happens, but for most of us normal people who don't have 10 citations in nature, I will say it's not going to happen. So there's not just because you can't get money now, it's not because there's something wrong with that. There's nothing wrong with your idea in whatever area you're in. But most likely, investor will say, oh, that's interesting, keep us updated. Now we're talking about professional investors. But that's the most likely answer you get based upon what I hear just where you are right now. Again, the disclaimer is I heard 10 seconds about each company, but I think you are relatively early stage. So just remember, just because you can't find investors now is not the same as there's something wrong with your business idea. It's simply the fact that most investors don't invest in business idea. Why do you think that's the case? Why don't you think investors invest in business idea? Is it because we're in Denmark versus US?
Well, maybe because salary is a huge part of it. If it's just a business idea, you need to do all the development for whatever business you're doing.
Mm.
So getting from a business idea to concept or product or whatever you're doing is a lot of money and salary.
Yeah, I think they're not that concerned about the money itself, but I think what they're concerned about is the world is full of business idea. And the value of a business idea, I have to say, even as an entrepreneur, is zero. Every entrepreneur you'll meet have 10 of those hidden. And then you can say, but I have a patent. And then don't get us started, right? There's actually a negative correlation between success and patent, but that's another story. So I'm just saying, it's hard to convince investors based upon an idea. Because they know from experience that what it takes is actually people that converting the idea to a successful company, and that most likely take 5 to 10 years. So they want to see people that actually can do something. And that's why you'll most likely be hearing, yeah, that sounds really interesting, keep us updated. They want to see that you actually can go from that idea to do something on your own. So just to avoid, if you should spend time right now, don't spend time on too much on investors. Of course, we're always fundraising a little bit. When one of those funds call us, of course, we take the meeting. I'm having one of those meetings tomorrow, even though I know the fund will not invest in my company, just to keep connections. And then, of course, there are investors that go in early. And that investor group is called friends and family and fools. These are data from US. I don't have from EU. I think the distribution is the same. This is actually the top funding sources for new companies. So the first one is actually yourself, personal savings and credit, right? The next one is friends and family, which is 3 times the size of venture capital and angel investors. And I think also one of you mentioned that. Yeah, that could be. So in US and in Europe, one of the big sources of financing initially is your friends and family. So what do you think the pros and cons of that source of capital is? Any idea?
Friends and family.
Yeah, friends and family, yeah.
Yeah, it's hard. I mean, it's not fun to lend money from somebody you know, because if your company goes down, then...
The Christmas lunch? Yeah. Yeah.
You're really bad at asking questions of what are you actually doing rather than just this, wow, that seems like an amazing idea.
Yeah, it's your parents, right? They always think it's an amazing idea.
It's amazing.
Yeah. Oh, that? No. Yeah. 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 Now, I will not go too much into detail of that. I think my own acid test is actually, can that person assume that you lose it all? Because there's a good chance they will lose it all. So if you lose 200,000 kroner from that person, can they continue the exact same lifestyle now and in 20 years as with the 200,000? If it's something they should have used for whatever it is, don't take the money. Honestly, it's not worth it. I've seen way too many entrepreneurs that are wasting too many relations on doing that, because it is relatively easy to get. You can go to the friends, you can go to the family and say, I have this new crazy whatever. And only do it if they understand what they're doing. But that's your own choice. I think it's just an important ethical discussion is really, do you want to accept money from people that have no clue? And I'll strongly advise against it. Have any of you taken money from friends and family? Because I have in my companies, and it's really a two-edged sword, right? Because you have companies, even though I think the friends that invest in my companies are semi-professional investors, but it's still, it's different in a good or bad way. It's good because they give you the urge really to do it good, but it's, I know personally a friend who got 2 million kroner from his dad, from the friend of one of his dads, and then the company got bankrupt. And the dad had maybe an equity of 10 million, so it was 20% of that person's entire savings. That's not good. And I was strongly against it. I think my rule of thumb is it should be less than 5% of that person's net equity. That's my own. Then you have venture capital funds. How much do you know about venture capital? Just so I'm not repeating what you already know. No? Have you had any courses about it? Okay. Because venture capital get a lot of attention, right? Every time, who have received venture capital in Denmark lately? Any companies you remember? No one? What? Trustpilot, yeah. Received from first Danish fund and then from Axel, yeah. Vivino, who else? Yeah, the two I'll just remember right out, right? But in size, in terms of investment, how many companies in Denmark do you think receive VC investments per year? How many new companies? 10%. No. I think 20 companies in total-ish. We have when I talk about real venture, I'm not talking about innovation centers, which I'll talk about later. Real venture capital. 20 unique companies, something like that. We have what? We have 5-6 venture funds in Denmark.
Just to put my insight in perspective, Morten Lund put in some money in Skype in the beginning.
Yeah.
Was that venture?
No, he put in 160,000 kroner. He will be called, but that converted into 75 million. That's not the case.
But where is the line from angel to venture capital?
Okay, I'll come to that because that's very different. Because venture capital funds look for something that becomes extremely big. I'll not go into detail, but just remember, something that becomes extremely big. And that often means that they look into 3 areas. IT, very, very specific parts of IT, life sciences, and some parts of clean tech. So basically, most of your ideas could be when it's something about reusable trash cans, most likely not. It's not become big enough. So if I was to say the rule of thumb, if you want to convince a VC investor, then it has to be something where they can get the money back 10 times. And they often want to invest at least 10 million kroner. So you have to do something where you say their share of the company is worth at least 100 million kroner in 5 years. So you can easily imagine that it's only a rare, Trustpilot got venture funding, 3 years after they got funded, right? They started very, very small. At some point, they become a venture case. So VCs are basically looking for some of the extreme. They're willing to take high risk, but in return, they want to have a high return, of course. And just so basically, you say if your company is not worth, in a good scenario, plus 300, 400, 500 million kroner, you are not ready for VC funding. Does it make sense? Because VC funds invest huge chunk of money that they want to have multiplied by 10. And then they know that more than half of the companies go bankrupt, but that's okay if the few ones become a Skype or whatever. Yeah.
How much shares of the company they want to get?
It's up to the government. If you are right now Dropbox is funding, and I think the new investors there will maybe get 1%. Average now, like for new companies, is for each round you give away 20% of the company. So if you have a first round VC and now you have performed good and you have started your company, and in 3 years you go to a VC and they invest 10 million kroner, most likely they want to have at least 20% of the company. They want a reasonable share. So 20% is a good rule of thumb if you're not Dropbox or Facebook. And actually, you'll be surprised that they invest later than you think. Because when you invest 10 million, that has to be converted into 100 million in 5 years, then you invest relatively late. So just because your company is not ready for VC now, it's not the same as it couldn't be ready for VC in 2 or 3 or 4 years. But I think my advice will just be that forget about VC right now, because they don't invest in companies like you. And it's actually not something about Danish one. I think in entire Silicon Valley, which is maybe some of the risk-loving, where we have most risk-loving venture capitalists, there's maybe a handful of firms that go into startups that early as you, or venture capital funds. Most venture capital funds invest much later. Does that make sense? So if I should give a real example, that's my friend's company, Recon Instruments, and they started in 2010 with one for ski goggle, and now they have just launched, like for Google Glass for athletes, what is built into sunglasses. Heads-up display, information, connections to smartphone. Yeah. And this is a classic example of the road to venture funding. That is, it actually started as a university project. They funded financing themselves. They got some free PhD. This is a Canadian company. Me and some other friends started investing. Later on, we got some really big angels on. We could actually have got a venture capital fund here, but the terms were not good. Then they launched the first product, and then they signed new agreements, and then they got venture capital. And this is classic. I think the most companies I see before they got real venture capitalists are 2, 3, 4 years old. So don't spend money on, yeah.
Could you mention something also about the management side, that they just not only come with money, but they
yeah, they all say they come with more than money, but in real life, they will participate in board meetings. So in real life, what they can help you with is maybe connections to other ones and say, oh, you need a CEO, or maybe they have a huge personal network, so maybe they can help you find the right person. But in real life, each of those partners at a fund sit maybe on 4 or 5 boards, and at the same time have to raise their own money and has to search for new deals. So they will not be hands, on the floor with you. They are board members, maybe active board members, but they're board members. So don't expect them to take a more operative role.
How many percent does of the business angel compared to the venture funding down there take?
That's all up for discussion. The only thing I can say, when you get one in a funding, that will normally get 20%. All that is up for discussion, in business angels. So business angels is anything from 0 point whatever to, in that case, I can't disclose the number, but we have a business angel who put in close to $2 million. So he got a lot of shares.
Okay. And a business angel coming in that early might as well participate much more in the daily management, right?
Yeah,
because
yeah.
Taking a huge
Yeah. So that is actually, I started talking about the venture capital fund because they are the one who are getting all the attention. And then my message to you is, forget about them now. It's most likely people like those that you want to get help from. So this is, as I said, really overview. It's like everything about VCs in 10 minutes, but I think that's the essence. Don't spend time on them right now. Code Sealer is one of my companies, which I actually got involved here. The real founder, the technical founder, had started the idea but couldn't really raise money, and then I got involved. And again, we raised money from business angels and innovation center, and then 1.5, 2 years later, we got venture capital. So that is normally how it works, is they come in relatively late. When it's IT, most, how many were in what's called classic IT companies? Yeah. Most IT venture funds invest, if it's business to business, when you have real revenue. And that could maybe be 5 million kroner a year, something like that. If it's on B2C, they don't expect so much revenue, but they really expect the user growth to be massive, right? Yeah. When it's on medical side, they come in relatively early, but often you will have university funding before. Hardware has really seen a change, because until a few years ago, actually when Recon was started, they all hated hardware, and now they all love hardware. Why do you think that happened? What does the switch happen in venture? My personal opinion is because they saw that Apple start making money on hardware. But again, hardware, they will not come in until you have proven that you can make it with partners and whatever. They are not the first investor. So have you ever heard about what is called the valley of death for startups? Have you heard about that? So what is that? Yeah, I think they're over there. Yeah. Yeah. And what's interesting is, of course, that initially the cash burn is not that big. So if you're into hardware, you make a prototype, whatever. I'm doing some plastic molding right now, and just to make the real tools cost 1 million kroner. So, and you still don't have any revenue. So this is a valley of death where it's relatively easy initially to finance because the money is relatively low, but then it becomes very expensive. And then you have that the VCs go in here, right? They're in late. They are in when you have some kind of traction. And that's why a lot of startups fail. And I think governments all over the world have tried to solve this in different ways. In some countries, it's been tax breaks. So if you're a private investor, you get some tax break if you invest early on. In Denmark, what they have done is they created innovation centers. Do you know those? Innovationsmiljøerne? Because my personal opinion is that they could become better in marketing themselves. Because this is 2012 data where they invested in 56 new companies. And compare that to the size of the VC, which is, I think, 15, 20 max. Of course, this is smaller amounts, but it's still 2 to 4 million typically in funding. So it's reasonable money, and they invest much earlier. So I think the way to describe innovation centers is they invest like a VC, but they just invest earlier. They still want to see the high risk, high reward thing, but they invest earlier. So if it's in IT, maybe you have a prototype. If it's business to business IT, maybe you have the first letter of intent from potential customers. If it's business to consumer IT, maybe you have some beta version out with some initial users on. If it's in hardware, you'll most likely have the prototype. You'll most likely have documented that you can make it at the specs. You maybe have a production partner, you maybe have a distribution partner, but no real revenue yet. That could be stuff like that. Does it make sense? So like VCs, smaller money, much earlier. Until 2014, we had 6. Now they've been forced to merge because the ministry who's paying it want to have, I think, more efficiency. So these two merge, and then we have these. So this is the one who's located just across the street, over there somewhere. They invest like VCs, they take equity. They can also invest in debt, but most of them is equity, anything from 25 to plus 50%. And one example is, that's one of my companies where I met some researchers who had this sperm quality test kit. So it's like a pregnancy test for home use for male sperm quality, because how many of you men have low sperm quality? Yeah, you will not admit it. That's true. That's why we have made this. And I think actually the route to funding is actually classic, because I met these partners who have done it themselves. I got involved, and we actually paid for the initial patenting and the initial prototyping. And then when we have shown that we could do it in small scale, then we actually got the money from an innovation center and a business angel. Will this ever be a real venture case? Maybe. But I'm not sure that it's big enough to actually satisfy venture funds. But it's still big enough from an innovation center. Any questions to the innovation centers?
I was just wondering, the 54 you mentioned, was it in total or per one?
No, it's in total. But it's 56 new companies. On top of that, they also make follow-up investments in old companies. So one of the most active one is actually D2 Symbion, located just here at D2. And I think they made something like 20 investments, 15, 20 per year. Anything from clean tech, IT, some pharma they have closed down, so because they couldn't really get it work. Yeah.
Can you say anything about the general differences between business angels and public innovation centers?
I think the difference is that a business angel don't have to see a venture case, something that can be really, really big. So for instance, if you have a successful consulting company or production company that want to scale. So you build a company, a small company, you want to have it bigger. Maybe you get a business angel in to invest, and he knows that in a good scenario, he can grow it to 2 or 3 times the value. That's okay with him. That's not a scale for them. They see themselves as filling the role between further financing. So they're still looking for something that can become really, really big. Where a business angel, of course, also want that, but it's also in many cases taking that is less risk and less reward. So that could be production company, distribution company, service company, stuff like that. I think another difference is that most business angels, per definition, want to be more involved. Because if you're a real business angel and maybe have made some money, why are you investing? For many other reasons than just financial outcome. So innovation centers are put in the world for a very specific purpose, to make sure to fill that gap, while a business angel invests his own money or her own money, and thereby have other reasons for investing. So let's talk about business angels. And I think just to take all the buzzword out of that, a business angel is just a private investor that you don't really know, you can say, right? So we exclude them from friends and family who invest in you because they know you. Business angel could be me. You know, I'm a business angel, or in a few startups, that could be. It could be entrepreneurs. I see a lot of executives who haven't started their own business, do it anyway. Old money, heritage, bankers. And the really, really big difference here is it's their own money. It makes a huge, huge difference whether you're administrating other people's money or whether you are investing your own. In Denmark, most of that is in equity. Debt, convertible debt, is extremely popular in the US. It's not really used that much here in Denmark. Make sense? Private investor taking a share of the company. And I've already discussed this, so I'll go briefly over that. Most business angels don't invest to financial outcome. One example, I know a few of my acquaintances that are business angels who have net equity of 100 million Danish to 1 billion Danish. Why do they invest? Is it to make 5 million? No, not really. Actually, seen from a financial perspective, maybe they would be better off just putting it in the stock market. So I think your learning is, if you want to convince a business angel to invest in your company, maybe there are many other reasons than simply to make a high return. Because if you want that, he can speculate in currency, he can do all kinds of things. So if you want something, of course, then green energy. Maybe the business angel wants to do something good for the world, right? That could be the trash can over there. Maybe it's one who had been involved in medical research and really wants to make a difference there. You know, maybe it's one who's made his own money in IT and wants to give a new entrepreneur the chance of making his own luck. So just avoid thinking that it's really about financial gains. And that's also why when I'm asked about what do business angels invest in, it's all over the world. It's from the craziest new medicine to a guy who have an e-commerce business that he wants to expand, but maybe that guy is located in the same village that I am and I want to support the local community, so therefore I invest in it. Make sense? So it's really arranged, and I think that's another learning is try to look when approaching business angels, and you can all find them in a directory on the website of Business Angel Copenhagen, whatever. Try to Google them. You know, what are they doing right now? So instead of just giving them proposals, they say, "Oh, Peter, we noticed that you're interested in clean tech, and now I have something that's really, really cool." Or you have a background for medical research, and look what I have now. So try to connect with them that way. Give them a reason to invest that is not about money. How to connect to them? We have these business angel networks. You can Google that. I think we have 5 of those in Denmark. But still, personal connections are far the best way to connect, because they go in that early. So personal introductions are very, very good. You know someone who knows someone, and then get a chance to pitch there. Many of them really want to be personally involved more than the VC, so that could be a chance for you. So okay, you have maybe the technical skills, maybe this guy has worked on the commercial side in the same industry for 20 years, maybe that could be a match. Many of them want to be more involved than the business angel. Any questions to the business angel? So how much do you know about crowdfunding? Have any one of you participated in a crowdfunding? Yeah, which one? Okay, I don't know what it is.
That's in virtual reality.
Okay, yeah. So this one, which one was it?
AlterGaze.
Okay, so it's not the one that Facebook acquired. No. So it's a reward based, so you paid up front and then you're promised to have the
I just pledged and I'll get a t-shirt.
Okay, yeah. So that's a classic thing. In Denmark we have Airtag. You know, maybe one of are they old? Did you guys, by the way? Yeah. Very, very successful. You know, reward-based equity crowdfunding. You know, you get something back. Could it be the product? Right now we have MeMover. Do you all know MeMover? You know, the crazy, I don't know what you call that. So reward-based is for sure legal. But I can also guarantee there's a lot of product that it doesn't work for. My sperm quality test kit. Oh yeah, would you put that on Facebook? Oh, I just ordered one. Maybe, right? So what about my encryption software for banks? No. So if you want to have something for that, it has to be something that has this consumer feel, and you can get that distribution of information, right? Because I think if you're pledged in one of those, I'm sure you have put it on Facebook or LinkedIn or whatever and tried to spread the news, right? And that's why such campaigns like those are so successful. Could you get one up for this, many of your startups? Maybe not. I haven't found one of my companies, but that's also because I'm mostly into B2B that is suited for this. Not because I can't from a legal perspective, but I can't from don't think it'll work. Actually, I talked to one who said, actually mortality count is so crazy, so maybe it could still work on Kickstarter, because for each 10 that won't do it, there's always one who wants to be different, right? And say, yes, I want to spread the news about this sperm quality test kit. But honestly, I don't think so. Then do you all know what equity-based crowdfunding is? Have anyone, what is it then? Yeah?
Sell a part of your company instead of selling a product, right?
Yeah. And then if we forget about that and then rewind time 10 years and I stood here and said, and ask all of you whether you want to invest in one of my companies, that would most likely be illegal. Why do you think so? Why would it be illegal for me to stand and say, would you invest in my motility account or code seal or whatever? Why do you think in most countries that is illegal? Any ideas?
Legal.
People do not know if the risk is involved.
Yeah. Yeah. So that's why we have regulated stock markets all over the world. That's why you had, if you want to raise money on the regulated market, you need to have your prospectus approved by financial authorities, who then said it's okay what you write, and then you can promote it. If I stood here and said, would you want to invest in one of my companies for a share of 200 kroner per share, it will most likely be illegal. So that's a world we have lived in for the last 100 years, basically all over the world, for good reasons. Just imagine if I'm in pharmaceutical and I stood outside Rigshospitalet with the folder said, oh, do you have cancer? You know, you can really see a lot of things that I stand here, so I convince you to invest. And then we at the same time have the problem of startups' lack of funding. And then comes internet with the opportunity for startups to market themselves to private investors, which, as I said, in most countries is not legal. In US, they work with the term accredited investor, which means that you need to have some net equity and some income. And they regularly basically say, if you have that, then you know what you're doing, right? And that's also why if you look on the back of Börsen, where it said, invest in this solar park in Romania or whatever, and then it says, in brackets, minimum investment 400,000 kroner. Because the financial regulators had this rule of thumb in Denmark saying, if you invest that amount of money, you know what you're doing. So this one is, if you take the old standard, not legal. And then at the same time, regulators all over the world actually want to improve financing for startups. So all over the world right now, regulators are finding out how they should allow this one. And I think what most people agree is that it will be allowed in some way. In US, they have the Jobs Act, they also start in UK. And then the great question is it legal in Denmark? And then Finanstilsynet came out in November with this and said, yeah, if you do A, B, C, D, E, it's legal. Basically saying, if you do a lot of things that is not possible to do, it's legal. I will not be the legal expert here. I'll just say, yes, it will be legal in some way or the other. They have started to that. I think all agree that just have to find the balance between improved funding for startups, at the same time avoid these golden rush where I stand outside Rigshospitalet and said I can cure cancer. But you can also say, will it still be all startups that are suited for this? Because it still has something that has some kind of consumer appeal. You know, if I put my encryption software on funded by me, I'm not sure that the average person would invest. That's mine. So I think my take on crowdfunding is both reward-based and equity-based crowdfunding for sure has its space. And you can actually see some of the startups that just got funded by it in Denmark, Airtame and Mimo, whatever, would have a hard time having other sources. And maybe the biggest value of crowdsourcing is the market approval that it generates. So for instance, if I'm the owner of Airtame now and go to a VC and said, look, I actually had, how many backers is that? Several thousand backers who have never seen my product pay up front. Do you think that will ease the way to the equity? Yeah. And you know, exactly like Facebook acquired the Oculus virtual reality screen, you know, that they bought from $2 billion. You know, that was the most popular Kickstarter project of all time, I think, you know. So it gives a credibility to test your market. And you can, of course, you don't have to do it on a site. Actually, Dan, my friend's company, they did it on their own site. They pre-ordered their new one and basically said, spread the news. you can order here, and then we deliver in 9, 12 months, right? A reward-based crowdfunding. That was my quick overview about investors. And then we'll see what time it is. Because we have more or less half an hour left. We can do that in 2 ways. I, of course, can do some slides about material to investors, but I would actually rather say, if you have some questions, we can take a Q&A now. So, what do you think? Who will be the first investor in your startup? Or do you need investors? How much money do you need?
We've been discussing this a lot. We're doing these hardware devices for monitoring vaccines and crops as well. So it costs some money, partly in hardware and partly in just having an office where we can build stuff.
Yeah.
So we've been discussing this. Say, well, half a year would, if we really aim for something, then at least 200,000 Danish kroner.
Yeah.
If we really, but we are 8 guys. We are both software developers, and so on. Yeah. And it seems costly in our head, but if the income, well, if the reward in a year is...
And I actually think the 200,000 is actually borderline whether you should go for investors or not. I'll say you should never go out and ask investors for 50 or 100,000. That's at least my opinion. Why do you think so? Why shouldn't you never do that? Yeah.
Unambitious.
Yeah, but it also is signaling, right? So for instance, I'm an investor, I want a significant share of your company. If you're 8 persons, and now I'll just say you ask for 100,000, then I will say that is 12,500 each. So why are you not investing that yourself? I know your bicycle out here costs the same. Not to be too arrogant, but that's actually how an investor will think. So, and the amount of hours that you will be spending on raising 200,000 early on, not from friends, family, that might be a good start, friends and family, but from professional investors. So you should separate and say, my own net equity and family friends, maybe yes, because they evaluate my business in another way. But professional investors, including business angels, I would say you should wait as long as you could. So in your case, I would say your biggest cost is most likely not the hardware. It's most likely not the office. The biggest cost will most likely be the salaries if 3 or 4 of you will go all in on that. And then I think your investment will then be no salary for 6, 9 months. And that's what you should then go to the investor in 9 months and say, look how far we have come in nothing. And now we actually have this prototype, and maybe it cost you 50,000, which you got from friends, family, and yourself. And that you're then raising 500,000. That would be mine. How many of you, are you all working part-time on that? No? No? Yeah. Because that's another critical element most investors will think about. That is, I'll give one example. We're not naming names. I know an investor who have invested quite a number of startups from young students. Coming out of CBS, have a good idea. He actually invested very early. And what he have experienced is that he go and he invests maybe 1 million in the team. And 1 year later, despite all the big plans, it takes longer time to execute the plan. It always does. And maybe it goes up and down. At some point in time, the students get tired and got a cool job offer from Novo Nordisk or McKinsey, whatever, and off they go. So what an investor really wants to see, that is that you're committed, that you really want to do it. So the first thing that they will ask about when they talk about 8 persons, that is, how many of you are working full-time or want to work full-time? So I think my advice for you is saying you actually have the great startup financing right now that is called SU. And I think doing part-time is a great way to start. It'll be hard to convince investors until you're dedicated to the project, because they actually are investing in you. They're not investing in the idea. They're investing in you. So you have to show dedication. I'm not saying that dedication can't be shown part-time, but I'm just saying it's harder, especially when you are 8 persons, because then all the red lights starts flashing about who has ownership and who are really dedicated, right? So in your case, my gut feeling will be that for you to raise 100 or 200,000 right now, excluding friends and family, will be very hard. So I think one way for you to find out how many of the 8 who really want that is actually to say each of us are finding 25,000 from loans, savings, friends, family, whatever. And then maybe you'll find out that only 3 or 4 want to participate. And that's very, very good to find out right now. And then you maybe separate the cake and say there's one who's in it all in, and then there's some who have a smaller share of the pie because they are not really dedicating that much. That's at least my advice.
So time and money is always the same?
In what regard?
So you're saying that one is able to put in full amount of hours, and then 2 is only part-time in it. So how much equity do you...
That's really, I think the one thing, the one mistake I often see with these founders is that they separate the entire pie right now, and they say, oh, we've come so far, and we are 3 persons, and we have 33% each. But the investor will know that it's only 10% of the work that's done now. So how do we ensure that all 3 are committed full time? Because especially if you're 8, I can guarantee you in 1 year, it's only 5 of the 8 that is working on the project. So what you really want to try to avoid is that 3 persons have 3/8 of the company. So the one I would like, first of all, you have to involve a lawyer relatively fast. And then you make a shareholders agreement that makes sure that you have the incentive to work. And if people don't want to dedicate themselves, then they have a much smaller share. That's at least mine. So you're basically saying, well, instead of having share the pie now, we have this small pie. Maybe we each having 1/3. And then for each month we work, we get something. I think that's a way to proceed. But in short, don't go to investors for small amounts. Because just the paperwork, if you want to have an investor, you should also do your paperwork, right? And that will easily cost you 20,000, right? Because you need to have a real shareholders agreement and all that. So don't do it for 100,000. Does that make sense? Yeah. Other questions? Yeah.
Maybe about if a VC or an angel investor or something gets a share in the company, say 20%, and he wants to get out at some point.
Yeah.
I mean, that has to happen as well.
Yeah.
What do you do then?
Well, I think there's 2 issues in that. First of all, initially you have to convince them they can get out. That is something that can become big. And then, of course, you have to convince them that you're ready to sell the company in 5 years. But you can also find business angels that actually want to be in for the long term. But if, of course, all that is regulated in the shareholders agreement, who basically say, what if a person wants to sell his shares? And normally you have arguments like tag along and drag along, which basically means that we try to force everyone to sell at the same time. So if you have found a buyer for your shares, the buyer should also offer to buy the other shares, etc., etc. So that's how it is to be a minority investor. And that's normally not the issue, because the VCs, the angels know that. They know that I only have 10% of my company. I think in all those companies I'm bound by such rules. So basically say, for instance, I can't sell my shares in that company right now. If I want to sell the shares, I have to notice the board saying I found a buyer for this share, and then the other have preemption rights to buy my shares. But I think the most important for you initially is to find a story that is valid, saying, yeah, we think we can make this scenario out here. And then the VC buys into that, very well knowing that he might end up with a company that not perform that well. And then you maybe have the option to buy out the shares. But you can't really arrange that beforehand because you don't really know. Sometimes I meet entrepreneurs who want to have clauses in saying, I want to buy back the VCs or the angel shares for 3 or 4 times the amount. And most rational angels and all VCs will say no, because I think you mentioned the Morten Lund Skype case, right? What if he had one of those clauses in? we all want to be part of that success story, right? So normally you say he has 10%, you can't really get rid of him. You can give him an offer to buy the shares, or he can give you an offer, well, you want to buy his shares, but you can't really agree that up front. It's really, really hard. Yeah. Yeah?
I have another question. Maybe you know about the Podium case?
Yeah.
Because I've heard a lot of stories about this amazing startup with a lot of people. They were, I think they started up with, I think I heard 20 or something like that. And then Tommy Ahlers came into it and he bought his way in. Do you know anything about that? Because it was just, they were a lot of founders from the beginning.
No, there was not. As far as I remember, there's 2 founders, and then there was a third. Oh, okay. I actually tried to, the good thing is I don't have inside knowledge about that case, but I actually did, in one of my speeches, I did a back of the envelope where I carried it backwards and say who got what. Because I think the case was you had 2 founders, and then you had the first technical guy who also got some shares. Then you had Tommy Ahlers, but he came in after Madsen Mygdal came in. So these 2 angels came in, and then later on came Sunstone, who then bought themselves in as a VC, and then later on. So you can say the flow was actually a few founders who I think maybe there was actually a small angel, unknown angel before. I think so. So I don't think there were 20 people. I think, if I should guess, I think maybe there were 8, 10 people when Madsen Mygdal came in, maybe 10, 12 when Ahlers came in. Then maybe each of them had put in, what, 1, 2 million each. I'm just guessing. And then they grew it, and then Sunstone came in, and then they exited 1 year later. That's normal. So that's, I think, actually is a classic case on different kinds of investors. And that's also, I say, the first investor you will get, or the first shareholders you get, should be your employees, because you can't give them a reasonable salary. So you say, I give you this shitty salary, but instead you give them these options in the company. And I think that's the most important. So and there you of course have the difference between co-founders and early employees. But most likely, for instance, in those startups I'm involved in, hire a back-end programmer, the real market salary would be 40 to 50,000, right? So if I only can pay the person 30,000, then I have to pay him shares instead. So if you stand on that, I would rather give 20% of my shares to 2 or 3 key programmers, and then wait 1 year until I get the angel or the VC in. Because I'd rather have it's the key programmers who get the shares, because I have all these clauses saying if they leave the company, then I get the shares back. But that's another story. And all that is also including is, remember when you formalize, it's okay to play around like this, I've all been there, but at some point in time where you really want to dedicate your time and your career and go full time, get all the paperwork done. And that is a clear-cut shareholders agreement saying, what happens if? What happens if you don't want to work in the company anymore? Should you keep your shares? Should you not keep your shares? What happens if you get divorced? Because then your ex-wife actually have half of your shares. So should you there's all those. And it's actually not that expensive to do that paperwork. And it forces you to think about all these things that are actually more important than the stuff I think talk about here. Because the most important thing is that you regulate your company, the core team. And that is, and it's really hard discussions often to have, to say what should actually do. But I would really say, I've been in companies where we waited too long, and then people say, but didn't you promise me whatever? It's just much easier to do it early on. Maybe getting an angel investing could be a good excuse, because then you're forced to do it. But just, I had this in one of my companies 6 months ago, where we basically had to sit down and said, well, what if you quit within the next 2 years? Should I be able to buy your shares? If so, at what price? Or should you be allowed to keep them? And that is extremely important, especially when you're 8.
And is there a difference between, what do you say, people with strategic? Well, you can have people in a group of these 8, for instance, which is our thing going on right now.
Yeah.
How big a size of this cake are you going to take? Can you say that people are basically out of decision strength or decision ability? So in the strategic part of this company, there's simply people having a B stock and an A stock.
I would say, I think it's always hard. I'm involved in a company right now where we have 6 founders, right? And we've said all get the same salary. In the market, they will never get the same salary. So we said that they all came in, we all dedicated at the same time, you get this. And most likely you'll need to do that. I think the A and B share or the whatever, and who get 20% and who get 10%, I think the one you can force that through is when you found out who is dedicated, who wants to do that as a real company. Now we have this student company that's fun, we have played, we have learned a lot. Now 3 of us want to go full time. And then if I was one of those 3, I would sit down and said, well, we are dedicated to that. Of the future, we should have a bigger pie than these 5. Does it make sense? I think that's the way. In Italy, it's extremely hard because all will say, well, we've all been in at the same time. But normally you have like saying 3 founders, we shared like each. But then if one go full time, he of course should have a much bigger part than the ones who got part time. And that's all why having all this discussion and paperwork. And if you can't afford or won't afford a lawyer right now, then just doing it in your own words. Put a paper, sign it and said, maybe it's not legally binding, but it's binding from a moral perspective when you have to discuss it 1 year later, saying, we agree that A has to work full time from that. We cannot give him a salary. Instead, he will have 40% of the company and the rest will have 20%. Something like that. I would do that if I were you. Yeah? Other? I'll just take a few slides then on material. Yeah?
I'm wondering, if it's an insurance company, for example.
Excuse me?
Insurance company.
Yeah.
Who has a small group where they invest in startups like
Yeah.
this.
Yeah.
Would you call that a venture capitalist, or would you call it?
That's actually called corporate venture. So many big companies have tried to do it. Actually, most of them have failed, but that's another story. So most Intel have a VC group, Google have a VC group, many big companies have tried to do it. Yeah, and they try to invest like a VC, but within the area where there could become synergies to the other one. So actually in Recon Instruments, one of the VCs that are in is Intel Capital. Why is Intel in? Because they want to place their Intel chips in the next generation of wearables. So they will mostly operate as a VC, but they will look for synergies to their mother company's portfolio. Yeah. Yeah. So a VC. Yeah. So the 10-minute version of material. The problem with business plan is that they're too long and focus on unimportant things. Like how much should we pay in rent next year? It's not important. So what is important are key variables actually, like if it's in hardware. I'm involved in hardware with this medtech. So that is actually what will it cost us to produce that? You know, what will consumers pay? What is the margin in the value chain, right? Really customers pay that. So actually the most important thing in a business plan are a few key concepts saying, okay, you think customers will pay €1,000 for this product. How have you proven that? You know, what kind of data do you have to support that? You said you can produce it for €100. You know, where do you have that? And the problem with most business plans is that they're too long and focus on the wrong steps. Another problem is that formal market research has very limited validity. So how much do you know about market research? Like focus groups, surveys, whatever? Have you had courses in that? Yeah. I'll not go into detail, I'll just say, when it comes to new product, most new companies and most new businesses have no clue what they want. None of us knew that we wanted one of those. None of us knew that you suddenly want an Apple instead of a PC. None of us. None of us know what kind of clothes we want next year. Most businesses will not know what kind they really want. So the problem with market research is that you ask a company or a person a question, and most likely they have no clue. So they say what they think, but the validity between that and what they really do is close to zero. And that is the key problem with market research. And this is an example from Dan's, my friends, where they ask about whether there's a need for a built-in camera. And they asked the right people with the right method, and they all said no. So they ranked all the key features, and this was one of the low-ranking features. They didn't really want it. And then 8 months later, all complained about why wasn't there a camera in the first version. What happened? What happened in the meantime? Why didn't consumers know that they actually want a camera?
GoPro.
Yeah, GoPro. So it was not until consumers saw that other skiers uploaded their videos to YouTube that they said, oh, we want that. And you can say that it's only for consumers, but it's also businesses. So what an investor wants to see is, of course, that you out talk to people. But what he really wants to see is this answer valid? And in most cases, you want to see that they actually has commitment. So for instance, there's a big difference between me going to a company and say, do you want to buy this software I make next year? Then the company can say yes and no commitment. But if I go to the same company and said, would you sign a letter of intent saying that you want to test this software when I have a beta ready in 6 months? For most companies, if they sign, there's a big, much higher chance that it's actually a valid result. Does it make sense? So you want commitment. The same goes for end users if it's B2C. And that is, if I just ask you, do you think this service is nice, you'll say yes. But can I in some way engage you already now in a beta version or something like that? The chance that it's valid result is much higher. Yeah?
But there's no risk in signing a letter of intent for testing of the beta.
Yeah, no, but actually in most companies of a certain size, for instance, I sell software to banks. If I have an employee in IT department and bank sign that, I know that he's not allowed to sign until he has been around to 5 different departments. So when I got my LOI back, there was 5 signatures on. So I know he only doing that if it's really valid. And what you of course can do is saying there's a small fee involved. It only costs you 10,000 kroner. 10,000 kroner, 20,000 or 50,000 is nothing for a bank. So if you can put some kind of money in, so you want at least to have them to dedicate time and try to show some kind of commitment. And of course, what you really want to do is like the AirTeam example, where you have people to pay for the product up front. It's not always you can do that. If you come with a really innovative product, in many cases people will say, yeah, but you know. So if you can have people to dedicate time, that is almost as good. And then you can say, yeah, maybe it's not legally binding, but in most companies, there's actually quite a barrier for signing such document. It's really, not in my own company like 5 person, but if you come to a companies of plus 100, 200 people, it's really one. So my gut feeling is, maybe you need a business plan, but don't focus on big market research of 2,000 companies you have asked. Most investors would rather have that you have talked in detail with 10 companies and said, if I do this, then it will fit into my software, and yes, we will buy it. And then you can say to the investor, by the way, you're also allowed to call Peter. That's how we got money from my Code Sealer project. That is that we have LOIs from 3 banks who basically, and then the investors are allowed to call the bank. And they said, yes, this is really innovative product. So if you can do that, then I would suggest try to work with a simple concept where you try to put it in 1 page. It could be the business model canvas, or it could be another concept. Try to keep it short. So instead of starting with a long business plan, you start with having it down on 1 or 2 pages. If you can't get you down to 1 to 2 pages, you have a problem. Then you can always elaborate later on with more detail. And then you make an executive summary, investor presentation, business plan. We don't have time to talk. So if I should sum up what I said, then it's basically, most likely you shouldn't care about investors right now. What you should care about is how you make the team and how you can incentivize the team to perform. So if you have 8 people, it would be great if you had 8 full-time people and need for 8 full-time people. Most likely will not. So then you find out that you actually need these 3 Then you make a shareholders agreement describing all those and maybe make a formal company and set up that. And then, take it from there, forget about VCs right now. Your most likely investor after your friends and family is business angels or innovation centers. Innovation centers look for the next venture case. Business angels look for something different, depending on the individual business angel. So before approaching the business angel, find out what have he done. Target business angels that are in the same industry or region like you and say, well, there's synergies with them, and offer them more than just money. And then later on, maybe your company involved to a venture case, but don't spend time on that. And then remember that investors, whether they're private or institutional, are very local. So don't do the mistake of touring down Sand Hill Road in Palo Alto, because the chance that they will invest in your project as a Danish company right now is zero. And then don't overdo the business plan. Start short, and instead trying to testing these hypotheses about the market need, especially. You know, can we prove there's a real market need out there? There's so many technical innovations where there's no real need. So go out and find out that there's actually someone who wants to do that. Yeah, cool. I think time is up. You're always welcome to send me an email or call me. I think my contact information is on the front page, which you all receive. Cool.
It's now time for Morten O. Petersen from KPMG, and we still focused on funding, but we'll add something also about tax and accounting. So stay focused and enjoy.
Thank you very much. First of all, I think it was very inspiring with Nikolai's lecture here. I also learned a few things. It was very operationally focused, but I think personally I very much liked that he also has this view that the legal and corporate structure side is perhaps boring, but very, very important to have focus on. And I'll take you through some stuff today that I think you'll find very interesting and very relevant, even though it's only a very small portion of your time during your whole startup phase that you should devote to these things. Getting it right and making sure that it's not a problem for you later on is very, very important. So what he talked about is what you use 95% of your time on, which is creating a successful business. And what I work with as a public accountant is creating a sound foundation, which also my colleague Jørgen, who's a lawyer, helps some of you with on the legal side. So my name is Morten. I'm 34 years old. I'm a Danish public accountant from 2011. I've been working at KPMG for more than 10 years now. And actually I work at the new KPMG. You might have heard a little bit about our company in the media. So I quit and joined the new company because the old company will join Ernst & Young this summer. So, but that's just another thing. I'm also an external lecturer at CBS, where I teach and have done that for several years. And I actually do some of the same work that I've done here at DTU now for 2 years, helping startups like you. I've also been doing now at CSE at CBS, where I also meet a lot of startups. So I have a lot, I would say, of experience from the last 2 years answering many of the same questions regarding setting up a company, what are the risks, what are the considerations, these shareholder agreements, as was also mentioned. So Actually, I brought on something about financing today. I think it was covered very well by Nikolai, so I'll take that down to maybe 3-4 minutes of just some practical advice from my view, from talking to maybe 30-40 startups the last 2-3 years. A lot of the same key things, generic stuff that I think you should consider. So what I'll take you through, and this is actually not only Denmark oriented, because the whole Western world has basically the same legal system around corporations. So if you just get the basic concept on this, it will also be relevant in most other countries, even though the rules are a little bit different. We'll come through planning a corporate structure, tax considerations for an entrepreneur in Denmark, very short on the administrative requirements. It's not an accounting course today, I'm sorry. That's pretty boring even for me. I have some considerations on liquidity and capital, not on the stuff that Nikolai was into, but more, I would say, from a negotiation perspective. And then I have a short perspective on European tax rates. We all the time talk about Denmark as being a very expensive country from a tax perspective. I think we should just look out and see what is actually the picture when we look out into the rest of Europe. So that's the agenda. And we'll have a Q&A session in the end. We also have a whiteboard where I can draw some structures if you have some specific questions. I have a pretty good experience with that. So planning the corporate structure in a startup. I would say, as in all things in life, planning ahead adds value and reduces risk. And I think one of the things I've learned working with these many groups of startups is that a lot of people rush in and keep on going too long before they seek some advice. Now, some of the groups here today, I offer as part of my collaboration with the Stardust program to have meetings with you. And I'll invite you all to contact me after today, because it is very important, probably many of you have also met with Jørgen, that these discussions are held reasonably early on. And I think that's also a lot of Nikolai's point. It's so much easier to decide who owns what and all these things early on as to waiting until we have something that's valuable that people can fight about. Because I can tell you, you can use a lot of time arguing later on, and that's not very constructive. Before going live, consulting advisors, that can be lawyers or auditors, and considering possible fallouts of the future activity. One thing I've learned is that if you look at a timeline, a lot of people will say, right now we are at this point and we're going to this point. But remember that there is a lot of uncertainty in what you're doing. So there are many possible fallout points, and the curve that you're going down can go up and down. There's a lot of different situations. One of the main things is, if you're a failure, you don't need to plan a lot. So the main key thing of the tax advice and the corporate structure is, if we are a big success, have we then thought about it and created the right setup for that situation? Because if you just fail, I mean, then it doesn't really matter what you did, right? But you never know, and you need to consider it. And some of you guys here have some very scalable business models. Some people don't have that, and then it's not very relevant to plan. But if it's very scalable, if it's potentially very valuable, getting it right from the beginning is a very, very important thing. And one of the main questions is there a possible best case significant value potential? And for a lot of you guys, there is. It's technology, it's scalable, it could go global. This, I would say, for most of them, I can put a check mark. It is very relevant to also consider how fast could we potentially go to this scenario. And that could be potentially very fast. So again, a very important thing to consider. Are there risks of being liable? Can the services products incur losses on customers? Well, some of you might think, okay, let's do a beta phase. Let's go out there. Let's try to engage some customers. We don't have a company yet. We don't really care. I'll come back to it, but it's very important to consider this fact as well, because if there is a risk of being liable, suddenly having a company becomes so much more attractive. Come back to that. And then the last one, does the business model require a steady sale of ownership to ensure capital? I think Nikolai also went into this, but the way you usually do it is you don't just have one round of funding. You have several rounds, and looking into how and when are we going to potentially bring in people is very important. So going more into detail, if the business case seems very valuable or potentially very valuable, the entrepreneur should consider taxes on capital gains as a very important factor. Is this very important because you all want to drive a sports car and have all the money for yourself? Not only therefore is it important, it's also important because if you, for instance, gain a lot of money from your first startup, being able to invest that money cash-free into another startup, into other projects, is actually possible if we have the right corporate structure with holding companies, and I'll come back to that. So it's not just a case of I want a lot of money for personal consumption, it's a case of do I want to protect any potential gains for other investments later on. And as you can see on Nikolai and others, once you get into this and you are successful, you very potentially will want to invest in other projects as well. If the business case involves taking risks or delivering services or goods that could make the company liable, then separating the owner from being liable is key. So are there some of your projects where you're not having a company right now? You guys don't have a company right now?
Well, it's in the process, basically.
It's in the process, but you don't. Do you deliver anything to any customers at the moment?
Yeah.
Okay.
But it's prototyping. Yeah, it's prototyping as experimental.
Okay.
Research, basically.
What is the product?
It's a hardware device with batteries and everything
Okay.
that can explode.
Okay, good. So let's say you delivered this device to Novo Nordisk IT department. They took it into their biggest server room, close to, I don't know, the heart of everything, and it blew up. Potentially, the 8 of you would just receive a letter from their lawyer a few weeks later where they said, you're liable for 100 million crowns of lost hardware. And of course, nobody at Novo Nordisk could work for 2 days. We have assessed that only being a loss of 200 million. I'm not trying to scare you guys. What I usually say on this is, if you have a company where there is I wouldn't say extremely remote, but just a reasonable risk, then always consider this before you start delivering something to customers. Some businesses are very low risk. I usually take an analogy to some blue collar work. If you're a painter and you paint the wrong color, you come back the next day and you paint the right color. So it's not hugely risky. Of course, if it's poisonous paint and everybody dies, it's not that good. But generally, I think people will agree painting is not the most risky job. If you, however, do plumbing, and the first day you go to a 10-story building, you work with the plumbing for 500 crowns, and then you leave, and then the water just gushes out in the whole building. Maybe you've made, just from doing a little bit of work, you've made a water damage worth millions and millions, potentially damaging the whole building inside. So always consider, is there a risk with what you do? And the great thing is, if you have a company, and it was in the company's name that you did this plumbing work, what can you do? You're being sued for millions and you've damaged and it's your fault. What can you do if it's the company's name that actually did the work? It's not you personally, it's the company that did the work. You just let it go bankrupt, because that's what companies are for. It's for making people aware and willing to take a risk. So the main reason why we actually have companies is because people are not willing to take a personal risk. They want to have a vessel that can take the risk, and if it goes wrong, they're not personally liable. They only invested some money and the rest can just go down. Some of your business models are not risky at all, but some may be, and especially software, I think, can have some hidden risks, because if your software damages other software, create breakdowns or all kinds of unforeseen stuff, potentially you could cause damage to others even though it wasn't your intention. So I think it's a very valid point, but most people think the risks are low, I can't even see it as a risk. Do a small session one night, maybe get drunk and discuss if there aren't any risks, and I think you will all, or many of you will be able to see there actually could be risks in certain situations. The last one, if lots of capital will be required, plan a structure that maximizes the entrepreneur's future value and ownership. Now that's pretty basic, but one of the things we've seen until last year, when we had, for instance, a structure called a SMBA, which thankfully doesn't exist anymore, was that people created structures where it wasn't possible even to get investors to invest. And also if you have a personal company, like the 8 of you that don't have a company yet, even if I wanted to invest, I can't invest in you guys personally because we don't have slavery, I can't own a part of you. So it's not possible for me to enter your business as an investor because you don't have a vessel that I can invest into. So a very important thing. In Denmark there are 2 main forms, and I'll come back to the third one because now we actually have 3, but there are 2 main forms of limited liability companies. the aktieselskab with a capital requirement of 500,000, the anpartsselskab with a capital requirement of 50,000, and now we have the IVS as well, which is an early phase of an APS with a capital requirement of 1 crown, and I'll come back to that. These all live up to the basics of the Western world, which is that a limited liability company is a vessel that is its own, you can say, judicial person. It can die, it can go bankrupt. You only are liable for the money you put in, and you can take all the risks that anyone in the world are willing to put into it. So creditors, banks, they can do all they want with this company. If it goes wrong, you can always let it go bankrupt. And it's actually supposed to have that function, because if we didn't have this limited liability company, people would not be willing to take risk. Goes back to the 1700s, where people should invest in ships to go far away and pick up goods. And it's the same basic model that we're using today. So what are the requirements? Well, society has made a trade-off. If you want to have this very, very attractive vessel to have your business in, then you have to give something back. And one of the things is you have to publicize on the finances, because the bank, the supplier, that is the creditors, potential employees, potential customers, they need to be able to look into the finances and understand, is this a very weak company? Is it a company that's under big pressure, or is it a very wealthy company? And I think that's fair enough that they're able to do this risk assessment, so you have to publicize an annual report. Thankfully, I would say, audit is only over a certain size, so for someone like me to make sure that the annual report is correct is not a requirement in Denmark if the revenue is under 8 million, the balance sheet is under 4 million, and there are less than 12 employees. I think that's a good thing, because a lot of small companies don't need an audit. But if you go to the bank will probably ask that there is an audit, because otherwise how can they trust the figures? But if you don't have creditors or banks, maybe you don't need an audit. Most investors that are passive will also ask for an audit to be sure what's going on. There are requirements to a management. Be very aware, if you're in the management of a company and you do illegal stuff, then you can be personally liable. So if let's say in your group of 8, you create a company, and then everybody decides that you'll be the manager, it's an IVS or an APS, so there only needs to be 1 person in management. The 7 other people do all kinds of illegal stuff in the company. You have a special responsibility because you're the official manager, or direktør in Danish. So just be aware of that. On the other hand, very few people get convicted as long as they're not doing anything on purposely wrong. So if you just go bankrupt, you don't go to prison for that. It's only if you use the company to do actual illegal stuff and it was your intention. So as long as you're in good faith and not trying to cheat anybody, going bankrupt is not something you go to prison for. In some startup environments, it's actually something you become a hero for. You know, I have 3 bankruptcies, but I finally made it. So I would say, on the other hand, try to avoid making creditors, the banks, the suppliers lose money. And that's what I usually say to startups. If you have an IVS with 1 crown, don't go down to Elgiganten and buy 100,000 crowns of equipment tomorrow when you know that you can't pay it in a month's time, and then you'll just go bankrupt. I mean, that's not good business ethics, right? So if you always only buy stuff, only procure stuff from suppliers when you think there is a reasonable probability that you can pay them back, then you're in good faith. And if you know, most likely I can never pay them back, I'll just go bankrupt, then you're not in good faith and you shouldn't buy that stuff. You should just let the company go bankrupt instead. So I think that's a generally good moral. One of the things we'll see with the IVSs is if they are used speculatively, because there's a little fear that, you know, some shadier people in business environment will create hundreds of these small companies and use them for not very good stuff. But hopefully it won't be a problem, and for serious people like you, it shouldn't be a problem in my view. So, I mean, if there's a 50,000 crowns of capital or 1 crown, it's so little money anyway that in the big sense, I would say as a bank, I would be very restrictive in loaning money to such a company. I mean, I have 1 crown of capital, please lend me 2 million crowns. Most banks will probably say, I don't think that's a good idea. Just remember, when you sit in the bank, I don't think many of you should loan capital because it's going to be too expensive. But many banks will say, well, maybe you have an APS or an IVS or an AS, but please sign this piece of paper that you're suddenly liable for the debt personally. Never do that, because then you lose the whole person or the whole purpose of having a limited liability company. if you sign a piece of paper on the side saying, okay, I am liable for the debt personally, then it's as if you didn't have a company at all. So if you reach that point, better to let the company go bankrupt, sort of from a general perspective, in my view. So many good people have had businesses that went down the hill, and in the end, they saved the company for 1 more year, but they lost everything because they ended up signing these papers in the bank. And then the company had bad results 1 more year and went bankrupt anyway, but the people are also broke. So it's not worth it, and I think it bypasses the purpose of having a company. Of course, the banks don't really care because they just want their money back. Annual tax forms, even though you have a personal company, you also have to do an annual tax form. It's not very complicated, especially in smaller companies, but usually a person like me could help you with a financial statement without an audit and could help you with the tax return. And in a very simple company, it's very inexpensive to do these things. I mean, we're talking a few thousand crowns per company. And if you've maybe got help with one company or 1 year, you could do it yourself. That's not a problem. So, you have a question?
Yeah, it's maybe more of a legal term, but if you do something as an engineering student now,
yeah,
through a company where you risk the liability, and you do something which is considered, which you find out later, to be very bad engineering ethics, for example, and you...
What is bad engineering ethics?
I mean, doing something that was not responsible, for example,
making a dangerous product, for instance?
In any way, like harm you later on in your work.
There is always a reputational risk in everything you do.
But not in a legal sense?
I mean, to be honest, Denmark is not like the US. You don't get sued for many things at all. And as long as you're in good faith, I mean, I used a poisonous battery, but I didn't know. I mean, I made a children's toy in my startup, and it kills children, but I didn't know. So it's a very unfortunate side effect of my toy, and I've taken it out of the market and all that. But I mean, as long as you're not in bad faith, I think your risk is limited. But of course, if you know, and that's what I mean, you know about all these medical companies, right? Suddenly they have this one case study where people got sick, and they don't tell about that, but they tell about the other case study where statistically perhaps people got cured, right? So I mean, that's bad ethics, because the regulator will say you had knowledge and you didn't use it, right? I think you guys' risk is low. I think you should have ethics though, and if you think something is bad, probably don't do it or test it on yourselves or something like that. But I mean, many things are risky. I mean, making this camera for people to put on their helmet, I mean, how many people has that killed, that product? For young kids jumping off buildings to see, okay, I want to make a cool film, and I mean, how many people do you think did extra crazy stuff just because of that product, right? I don't think they have a problem, but actually that's some ethics in that product, right? It encourages people to do some pretty crazy stuff. So you also need to do bookkeeping according to standards, and it's very basic. All parts of the bookkeeping of a company has to be stored for 5 years, and you have to put numbers on all the vouchers. And the thing is, of course, if the tax authority makes a raid, you can't say, I don't have any paper in my company. What happens in such a case? The management of the company will be convicted. Unfortunately, in Denmark, nobody has been convicted of bookkeeping fraud for 15 years. Not even the biggest frauds that we have in this country have been convicted. So your risk is probably pretty low, but it's just to note there is a responsibility, and it's a very good idea. And one thing you should also remember is, if I came as a professional investor, one of the easiest things to do in my due diligence would be to say, let's say 2-3 years from now, can I see the last 3 years tax returns? Can I see the last 3 years annual reports? Can you please hand over the bookkeeping? And then if you say, we don't really, everything is shambles, they'll say, well, these guys don't have any clue over the administration. So either they'll say, we don't want to invest, or they'll say, these guys are stupid, so we'll take a bigger share because we'll just roll them over, they're not professional. So for that reason, at least when you get behind, or after the first year or so, try to professionalize it, and I would outsource stuff like bookkeeping, VAT, salaries. You shouldn't waste your time on it, and it's pretty cheap to buy this from service companies. And if you're not happy with the service you get, you just switch to another company. And I would use a cloud service as well. It's very easy to just change the provider. So don't worry about it. An engineer that uses time on VAT and payroll taxes and bookkeeping is wasting his time, in my view. So don't worry about it, but don't use your time. It's pretty cheap to buy assistance in this area. So the main alternative to these capital companies, which I've advocated now, is a personal company where the owner is personally liable without any limitation. And that's in principle your case if you are now 8 people. Even though you don't have a formal personal company, in principle that is the case. So just be aware of this. Of course, you're not very commercial right now, but if you, for instance, deliver products to consumers, consumers have a lot of protection in Denmark and a lot of countries. So a consumer says, I bought this product within 2 years, it's not working, I want another one, blah, blah, blah. There's a lot of risk. And the problem is, if you're personally liable, it's without limitation. You have to pay everything yourself. So my view is always, when we pass this commercial borderline, we need to be a corporate structure if there is significant risk. Everything else is just really stupid. The benefit of these personal companies is a slightly lower administration because you don't publish an annual report and the information is not public. But the point is, in a Danish annual report, you don't have to show the revenue anyway. So without omsetning, without revenue, it's not very informative anyway. So, but a few companies think that's attractive. I don't think it makes any sense to you guys. Taxes are slightly different, but it's the same requirement and you need bookkeeping. And a drawback to a personal company is that if you sell it, you incur all the tax right away and you can't get investors in. So if you sell a personal company, you pay tax right away and you can't get any investors. So it doesn't make sense to start up with a personal company. In my view, once you decide now we'll go professional, you need a limited liability company. Danish rules allow personal companies to be converted to capital companies or limited liability companies without a capital gains tax under certain conditions. But the problem is there is a 3-year ban on selling your new shares if you do this in Denmark. And that is actually quite a long time. And it's not without problems to do this. That's part of, I've done it for a few of the startups here and at CBS. My view is start up with the right structure instead of going through this process because it is a bit of a hassle to do it. It costs some money and you need both an accountant and a lawyer involved in converting the company. But it can be done tax-free. And I think we have a few girls here today who did this actually a few months ago. I don't think it was a huge hassle for them, but it was a bit of a hassle and maybe we'll come back to your example later on. So now we have this iværksætterselskab. Basically, it's an APS. The only limitation is until the equity reaches 50,000, you cannot pay dividend. But you don't pay dividend from a company with no money anyway, so it's not really a big restriction. When you reach an equity of 50,000, you can just yourselves, without involving a lawyer, turn it into an APS. So basically, it is in all legal and tax senses the same as an APS. Some people have said this IVS is not serious, people will look strangely at it. I can only say, for instance, for holding companies, which could be relevant for many of you individually, it's a great vessel because it's very cheap, it has all the same functions, and I personally don't see any reason why not to use them, because if a company has a capital of 1 crown or 50,000, neither amount is very big anyway. So banks and creditors won't make, in my view, any big fuss if it's an IVS or an APS. You also need the financial statement, but you can take away the audit part. You also need a management, but it's one, like in the APS. So if it's your own holding company, it's just yourself. And you need the annual tax form and the bookkeeping. So this is the basic situation that is very important to consider. If you own a company personally and sell shares to an investor, you incur capital gains tax. So if this person over here sells the company, then that person has to pay a capital gains tax. And in Denmark, it's about 43% on the first 50,000 per income year and 28% on the rest. So you think that's not too much, but it is actually quite a lot of money that you surrender right away when you sell. That gives you the opportunity, if you sell at a good price, to buy a sports car. But on the other hand, you're forced to pay the tax in that year. You cannot spread it out over several years. You don't have any flexibility. On the other hand, if you own a company via a holding company, then no tax is incurred in the first step. So when the holding company sells the operational company or the stocks, maybe you only own 10% of this company, then there is no tax in this level there is still tax up here, like in the other situation, but you have the option of only taking out the money for personal taxation that you want. You can let the rest of the money stay here and then take it out at a better tax rate or some other things. And the most important thing is, if you do as many investors do, you can reinvest the whole sum in the holding company in new projects without any tax being paid at all. So there is no cut, there's no part going to society. Now, why has society made this tax rule? It's of course made on purpose. Well, the purpose is that society actually wants people to reinvest in new companies, and society thinks it's a good idea not to take away the taxes, but to leave some money here to be reinvested. Because as you all know, it's hard to get investment already. So why not have more people being willing to invest? And I usually use an analogy where I say it's like a fruit tree. If you take off the apples to eat, then you pay taxes. But if you plant more trees and work sort of with your orchard down here, and that can be many companies, then you don't pay taxes because it's part of creating a bigger wealth base that can create more apples. And society says, don't pay taxes on that. Yes?
What if you can't do that? What if you don't invest as fast as you earn?
If you don't invest as fast as you earn?
You just make a black hole of money.
I think you need to rephrase the question.
Well, the thing is, if you have a structure where the money, if you make more money, the money, let's say, faster than you invest it,
Yeah.
then you will have some.
This becomes a money tank, you know, like Donald Duck. It becomes a big tank of money. And then eventually in a holding company that has very few costs and that has a lot of interest income because you have 10 million on a bank account, which gives no interest, of course, but if you had a big interest income, then you would be paying taxes on the gains each year or the profit in this company. But you're not paying tax of the big gain you took. Let's say you sell your share of this company for 5 million. The 5 million comes up here tax-free. You can choose to reinvest it. If you choose to leave the 5 million up here, you're right, you're not taxed. If you take them up, then you're taxed. If you leave them here, then you'll be, probably you would invest them in something, and the annual gains on that would be taxed in the company. Yeah? Yeah. Well, the reason is, I understand your question, but the reason is that society cannot decide if this guy should wait 3 months before he invests, 6 months, 24 months, or 36 months. He should invest when he thinks it's the right time to make the right move. If he was forced to just buy shares in all kinds of stuff that he actually didn't want, then we're forcing the investors to do things they don't like to do. And the whole part of this system is, it has to be the people who own the companies, who manage the companies, who are the best people to take the decisions on their own. And trust me, not very many wealthy people that own companies choose to say, I don't want to invest at all. I mean, most of them know, I want a higher return, I want to do some different stuff with my money. But I agree, there's a lot of political views on this, and I'm just talking about what the current system is. No, the Swiss banks invest very heavily in a lot of big companies.
Yes, but still
Yeah.
The thing is, doesn't it create a kind of
I'm sorry, my friend, but it's called capitalism, and it's not going to go away. I think that's my short answer. Because there are some problems with maybe that system, but the fact of the matter is, in a certain way, I must say personally, I very strongly believe that there's a lot of inefficiency in the system, but it is probably the most efficient system to make sure that people invest in what they believe in if they have the funds to do so.
So it's not possible to say what would happen if someone put down the rule of saying you're allowed to take the money out, but you're not allowed to take them back into the system.
I think we'll come back to it under the questioning round, but I mean, taxes is not logical. It doesn't always make sense. To a certain extent it does on the higher level, but I mean, there's a lot of things where you can say, why are the rules not different? And they also vary between different countries. So I hope you understood this point, and we'll go on. A much debated tax in Denmark, and maybe some of you have heard about this, was that if you owned less than 10% and you had the holding company, then you lost this advantage. So if we go back to 2012, there was something called in the media iværksætterskat, which meant if you only owned 5%, and especially in your group with 8 people, this could become a really big problem. Because suddenly somebody owned 8%. With the old iværksætterskat, this advantage with the holding company disappeared. So suddenly the people owning less than 10% were taxed even though they had a holding company. Now that rule was removed at the end of 2012. It does not exist anymore. The only rule that still exists as a part of this is that if you own less than 10%, you cannot get a dividend tax-free. A dividend is where you don't sell a single share, but shares give a certain amount of crowns or dollars per share in a dividend. In my view, it doesn't really matter that much because very few startups are cash cows, and that means that they don't pay dividends. It's a very mature company that's making a huge amount of money that pays dividends. It's not a startup because all the additional cash you have in a startup, you reinvest, you grow for many, many years. So it's not a very important problem in my view. The result of this is that small ownership shares in Danish companies again can be attractive, which is a key to many entrepreneurs. But I'm still meeting people that say, I don't want to own less than 10% because it's a very big tax disadvantage. And I can only say that's no longer valid. So that is not an argument to be used, but it was actually a big problem back in 2012 because a lot of investors could do calculations and say, less than 10%, then my business case becomes so much less attractive. And I think it's very important to just realize that for many of you as well, if your business becomes very big, probably many will end up with less than 10%. But I would very much like to own 8% of something very valuable. And then it's just great that we got this rule banned so that it is now tax-free if you have the holding company. What about these administrative requirements? Well, we've been through it just shortly, and to be honest, I won't use a lot of time on it. If you're a small business and if you reach a professional level, you can get a service provider out there who'll do this for as little as 1,000-2,000 crowns a month if you have very, very few pieces of paper or vouchers. And it's not worth hassling with it. I know a lot of young engineers who get all kinds of spam mail from the tax authority that they'll be sued and they're liable and all kinds of stuff, breaking the tax code and not paying personal income tax, which is one of the worst things you can do. If you don't pay salary tax on your employees and you don't do it very quickly, then you can be fined pretty big amounts. So leave it to a professional. An investor will also appreciate that there's no problem on this side, that we don't have 3 or 4 cases with the tax authority and problems like that. On the other hand, as long as you're not paying any salaries or maybe not even VAT registered, this is not a big issue. But professionalize it. It is pretty cheap. That's my view on that. What about liquidity and capital considerations in startups? I very much agree with what was said earlier on, that you shouldn't overplan. But you need a budget and you need a liquidity budget. That is a budget that starts with a bank account in the beginning of the month and ends with a bank account at the end of the month. Because the problem is, let's say you have some very valuable IP in your startup. Suddenly you fuck up your procurement. So you don't have enough money and you bought something very expensive. The creditor can go directly down to court and say, this little startup is not paying their bills. I'll file for bankruptcy. If you then go bankrupt, that creditor or somebody else might buy your IP out of the bankruptcy. So you definitely don't want to go bankrupt and lose your IP in a bankruptcy situation. So being able to avoid the bankruptcy, being able to plan and also act. So if you have a budget, let's say I agree with what he said, don't go away 3-4 years into the future. Let's say a rolling budget for the next 6 months. When you realize we'll run out of cash now in 3 months because we're using cash faster than we thought, then you have a crisis meeting right away, because 3 months away from the edge, you have so much more active freedom than if you wait until 2 days before the edge. You don't have a lot of opportunities. And the investors you're talking to, if you say, I have 3 months until we don't have any more money, I have 2 other investors I'm talking to. Give us 500,000 crowns and you'll get 10%. If you're 2 days from going bankrupt, he'll be, okay, you're in a tight position, right? I'll get 40% and you can get 250,000. So always negotiate from strength. And it's very simple, but the whole devil in this, and I've seen it now several times, is that the point in time where you can actually do something is not when you're on the edge, it's when you're 3 months before the edge and you were able to realize, now we're going to be in trouble. And you can do all kinds of sensible stuff. You can say, okay, we'll postpone the next phase, we'll fire the employees, we'll tell the suppliers we're not buying anything else. And you can easily go into, I would say, some kind of a dormant state in the company where you just scale down the activity and then give yourself more time. So you can do all kinds of stuff, but it needs planning and meeting up early on and talking about stuff, right? If you're 8 people and everybody just buys what they want, I only have 1 wife, and I know how bad that can go. So it's very important that you have some management on these on the finances. Very simple, but very, very important. And you always use more money than you plan, I think. Be aware that the annual report is not a cash flow statement. A lot of people are used to making, you know, we have this income, we have these costs, but it's liquidity. It's when do we actually pay the costs? When is the income coming? It doesn't help that you got a great order from a big customer, but the payment terms are they're not going to pay us until 3 months after we deliver. The liquidity budget is when does the money come in and when does it go out? So always remember that. A positive income in an annual report may cover a significant lack of liquidity, because one thing is, if you invest in, for instance, equipment, that's not a cost in an annual report. No, that's an investment that goes into the balance sheet and is depreciated over many years. So already there, some things are not actually aligning with liquidity. Be very aware of that. The liquidity is the main thing for you guys. Are we running out of actual cash? So the point of a limited liability company is not to be liable. Do not sign personally any liability clauses on bank loans, etc. Because that's what we see when you're standing on the brink, is the bank says, no problem, you don't have any money, we'll give you a loan. All 8 of you, please sign this, that you're limitlessly liable for the 1 million crowns you're now loaning. Trust me, they'll gladly loan 8 people 1 million crowns on your flat faces at a really high interest rate. But the point is, at least in that situation, consider, is this really what we want to do? Because then actually the point of the limited liability company is to a certain extent being circumvented. If you approach an investor when critically pressured for capital, the entrepreneur may have to sell out at a higher cost. Maybe if you can bluff them and say, we are so far away from the brink, maybe then you don't do that. But if they know you're under pressure, they will always use it to their advantage. So always plan ahead, not maybe years ahead, but at least 3 months ahead, and always negotiate from strength. I think it's so, so important, but it's really hard to do in practice. A short thing on corporate taxes in Europe. So this is the corporate tax, and I think that's a bit of an answer to your question as well. If you have a company, and the company has income minus cost, and it has a profit, that profit is the profit inside the company that makes the equity grow from year to year. Now that profit, if you have a profit, has a corporate tax. What were the corporate taxes if you look at them historically? Well, Denmark has been, compared to Northern Europe, pretty well off at 22%. The problem is then that Sweden dropped off to 22% last year. So we decided to do the same. This year it's 24.5%, next year it's 23.5%. And in 2016, Denmark will be at 22% corporate income tax. At CBS, I have several students that only want to start companies in Ireland because the corporate tax is, I don't know, 12 or 16%. My point is, why have a company in Ireland where there's a lot of other aspects of it, and investors in Denmark might say, okay, so now I need an Irish lawyer, and I don't know what. Denmark is not extremely expensive on corporate taxes. It's not a big deal. And you're here now, today. My advice is, Denmark is not a big hassle company on the corporate tax side. It's not very expensive, and it's, I think, with 22%, actually a pretty reasonable and attractive option. The US is much more expensive, that's 30%, so it's just for your information. On the other hand, when we look at individual tax rates, which is my personal income tax, that is higher, even though marginally in Denmark it has fallen quite a lot and is still here in 14 at approximately this level. What you also have to note, however, is that a country like France and a country like Sweden, they have an extra tax on the employer. So the company employing people has to pay a lot of extra money. And you can't see this in, for instance, the French tax, but there's actually an additional tax that the company has to pay on top of this, making that quite expensive in France, for instance. That's why they have the most robots in industry, what I've heard, in the whole of Europe, because people are just too expensive to employ. So just a short perspective on taxes. My general consideration is I don't think there are a lot of very good arguments to move to the Cayman Islands or Ireland or somewhere else. Generally, we're doing reasonably well, but yes, on the income tax side, it is a bit more expensive. But that's also why on the capital gains tax, if you end up being an investor, you'll get everything out at this flat rate, 28, for the first 50,000 and 43% on the rest. So there is a difference between having a salary income as the owner of a company and having a capital gains income from dividends later on. I had a little bit on this financing, but I think it was covered very much by the first lecture that was here today. I just highlighted some points on what you had. I don't think I have a lot of very sensible stuff to say compared to what he said. So I'll just leave the slides there. But overview, prepare and follow up continuously on the liquidity budget. A rolling budget is always a good idea because the assumptions last month might have changed for next month. I mean, the plan is, the only thing you can say for sure is the plan is going to change. So updating the plan continuously, having a meeting at least once a month discussing the plan is a good idea. And maybe a half-year perspective is a reasonable timeline to look at. Make sure that management or your team prioritizes costs in advance. I think big costs in the budget and stuff like that is a decision for the management group, maybe the whole team. Always negotiate from strength, otherwise you'll be squeezed. And a small thing, there is a lot of fraud, and all of you guys are very ethical, skilled young people, but it's my experience, especially if you get a CBS person into your team, don't let them run away with the money. So, no, sorry. But I mean, as an auditor, I've seen quite a lot of fraud, right? So my point is, if there's a lot of money in the bank account, and for instance, we have a few people here who are already getting some investment capital, it is a good idea to just have a limited amount of governance, and a very sensible, low-key thing is 2 people have access to the bank account, and they cannot pay out on themselves if there's a lot of money in the bank account. It's just a really good idea. Trust me, the investor coming in will make all these demands on you anyway. But just remember, even though you trust each other, for instance, how do you negotiate individual pay for people? And people shouldn't decide that for themselves. People shouldn't just approve their own costs for restaurants and stuff like that. Unless in the very early phase it's not a problem, but later on it's always a good idea to have governance. And as the owners, you have a special view on that it should be a success, but trust me, when you employ people, they'll be much more liberal as to, you know, how can I act in this situation, what can I do? So you shouldn't distrust everybody, just make a few sensible controls so that people don't get tempted to do something stupid. It's a good idea. I think that's what I had. Usually there are some questions, and I can take those on the whiteboard because then we can draw, you know, in our situation, we consider this, what do you think is a good idea? So if you have any questions, feel free to ask. Yes?
You said with the bookkeeping that you had to keep your invoices and stuff like that for 5 years.
Yeah.
Is that in the real world, or can you just...
That can be scanned.
Okay, so you can use it in the cloud.
I would recommend having a cloud service. The good thing about the cloud service, if you use, for instance, Economic, which is a bookkeeping server system, you can scan in all the invoice stuff. It's stored there. You have one service provider doing your bookkeeping and your VAT. You don't like them. Well, you say, okay, you guys log off. Next month, somebody else will log in and continue the work. Because in the old world, you say, oh, we have to transfer all the records. You have to print out. They use Navision. These guys use another system. I think with the cloud, actually, as a small company, you have a very big freedom of service. And you can choose another assistance bureau to help you because you own the data and it's the same system. So that would be my recommendation. So anybody that's not completely clear on what holding structure they'll have in their company, or is it all in place? What about you guys? Have you discussed?
Yeah, well, up until now we have worked on, we've created 8 IDS companies.
Yeah.
For,
so maybe we should just draw your structure? And everybody has their own IVS, is that correct? Yes. That's correct. That's a lot of annual reports and tax returns, huh? Yes. And I hope that when you make all these companies, you remember when you create the companies to deselect audit when you create the company. Very good idea. Very good idea. Yeah?
Can I maybe ask something that we discussed? For example, my dad is an accountant,
yeah.
And I've understood that he can't do my...
oh yeah, without an audit he can do everything.
He can do everything?
But he cannot be the independent auditor and do an opinion. Does that make sense?
Yeah, okay.
He can assist you with doing everything.
Yeah, okay, but I mean, yeah.
He cannot sign as the independent auditor because you're his son.
But could he sign the others, or is that
yeah, yeah, but you don't want an audit and use his time on that if it's not necessary. It is actually at his discretion to decide whether he's independent or not. So I would say it's always actually a assessment. But usually we say next of kin is definitely not an independent audit. So.
Then another thing that we discussed, we've talked a lot about how many shares or what equity we can have in the total company, and then we talked about some of us having some extra money to put into the company.
Yeah.
But since our firm, as it is right now,
there is only one company. Do you agree?
Yeah, right. But since we are very driven by like involvement and engagement into this company, we were wondering if there's a way of some of us putting money as capital into the big firm without getting more shares.
But is that fair?
Yeah, but
is it fair?
We've discussed it, and some of us think that it's fair.
Well, I can only say it's not fair, but it's very nice of you if you choose to do it.
But then, if I may rephrase, then in order to invest some money in it and gain some sort of outcome, which is not a larger share, because we really want to equal out the shares because we want to keep everyone's motivation up.
But to be honest, let's say I came to a company and I had nothing, and you came with 1 million crowns. Yeah. And you say, Morten, I'm going to get 80% and you'll get 20. Maybe I would be still very motivated because I got 20% for nothing, right? Yeah. So if people say it's very unreasonable that the ones who put down some more cash get a little bit different equity, I can only say it is not unfair. The question is, what is the valuation? How much does 1% cost? But if you're buying 1% at a price which everybody agrees is what 1% is worth at this moment, and everybody agrees that the company needs the money, I don't see it makes any difference if an external person comes and gives you money and wants some percentages, or if it's one of you guys who does it. And I think actually, basically, I'm afraid that not respecting that other people contribute some extra resources could actually create other tensions in the long run, because maybe some of the guys who gave money without getting anything would be, annoyed down the road. I will say one thing. In my view, everybody owns the same percentage here, right?
More or less.
More or less. So around 12 something?
Yeah, we've discussed it that some around 10 and some around 15.
Okay, so everybody owns between 10 to 15%. Actually, I think that's good, that you don't have a completely equal share, because, sorry to say it, it's not possible to have a team of 8 people, or maybe even 2 people, where everything is just equal. On the other hand, deciding what is fair is really hard, and that's where I agree very much with the last lecture, that having this shareholder agreement is just super important. So the shareholder agreement, because the shareholder agreement, let's say one of these people travels away to South America tomorrow. Is it fair that that person not contributing anything just rides on the wave of the 7 other people? The shareholder agreement would say, if you are completely obviously passive for, more than 6 months, then the other guys have the right to buy your shares from you at this or that price, or we do a valuation or whatever. So the problem with Danish corporate law is there's no regulation in our APS or AS law about how these things should work. Everything is negotiable. And that's why you should make the shareholder agreement before huge amounts of resources are committed and before things start happening. With this many people, I also agree very much with him. I think within a year's time, 3 people at least will have left. It's not very motivating for the other guys to be working and 3 passive people just sitting around. I'm not saying it's in a negative way, it's just not very motivating for the other 5 to create value to people who are no longer actively part of the project. And maybe you actually need 3 other people to come on that are now in the next phase much more relevant, but you're stuck with the old guys who are no longer important for the project. It's also my experience that people that actually leave projects often don't want to sell at a huge price. I mean, they just want to leave, they're fed up, or they don't want to do it anymore, or whatever. So having a mechanism that says, you don't even have to discuss this, we can buy you out, and now we're going to do it, and let's agree on a price, everybody's actually happy because there's nothing to discuss, there is an agreement. So I would say in your case, this is really, really important. You definitely want it. What will often happen when the investor comes in later on is investors will anyway come with new shareholder agreements and make rules for how they want it to be. So it's probably going to come anyway down the road. But important to remember, it's not in what we call the statutes of the company in vedtægterne. It's not in the statutes of the company. You need an extra shareholder agreement that regulates all kinds of stuff. Because that's the only way you can actually ensure that these mechanisms are made correctly. And in that case, you need a lawyer. I'm not a lawyer, but you need a lawyer to help you with that. And I really think it's an important consideration. And I'm definitely sure that you guys, if you really commit resources and believe in the project, you should have such an agreement. So have some meetings with Jørgen. Also, one thing I've learned is it's very hard to sit at a meeting with everybody. I don't have any personal siding with this or that person, but if I'm sitting with this person alone or 2 persons, they'll say, look, everybody knows that this person is a nice person, but it's not contributing very much. What should we do? Everybody should remember that in these things, you're not negotiating as a group. Everybody has to a certain degree some self-interest, and it's not a bad thing, it's just how it is. And I think it's important that everybody realizes that, because otherwise somebody will be sad when they realize somebody else got advice and why didn't you tell me? Well, everybody is negotiating from their own position. And in general, too many of the young university entrepreneurs, in my view, are a bit too naive. The professional investors, I mean, this guy, I wouldn't like to negotiate with him. He knows all the things you can do, and he has some good advisors. He's done it before. If I was going to negotiate with him and he was going to invest in my company, Nikolai, I would definitely have a lawyer on my side, because I would be very much afraid that he would know all the tricks. And you know, the typical thing, he would say, you know what, a shareholder agreement is pretty expensive, so let my lawyer write it up, right? Then I'll save you some money. Okay, that's very nice of you to do that. I mean, that's just how it starts, right? So always remember that even though they're not evil people, the investors will always use their knowledge or information arbitrage against you. And that's why you need some professional advice. If you're sitting and stuff like that, and you can always take a time out. You can always say, you know, I have to get some advice, I'll have to come back. I don't want to sign this, I'm not sure. Because you don't have the experience to be able to know if something is really a good deal or not. And usually something is never a good deal the first time you negotiate. It's at the 3rd time when you reach the final deal, then it's better. So yeah, always remember that. So I think this is a good structure. The brilliant thing about all these holding companies is if you only had one holding company and one person said, look, I have a very expensive wife, and one person said, I want a sports car, then the one holding company would have to do the same thing. So if it paid out apples, then everybody had to get apples. In this case, if you guys got a lot of money up into the companies because you sold parts or all of your shares, then this guy could say, I'll take all the apples and buy all these personal stuff. This guy could invest in a new company without any taxes. This guy could invest some of the money and take some of it up. So it gives everybody the individual freedom to do what they want. And also, if you buy out people at different stages, it would give everybody a flexibility to do different things. The only downside is 8 annual reports, 8 tax returns. But if the holding company is really smart, it has 1 crown of capital, it has almost no admin cost, so it's like 5 postings per year. Your dad would do it in no time. So it's not a big problem. And the best thing is, if you fail and you decide this is crap, we just want to close it down, what you can do in Denmark is you can make what's called a betalingserklæring. So if it's a holding company, you just write to the company administration, Erhvervsstyrelsen, and say, look, I'm closing down my holding company. Nobody's going to lose money because you know you've never bought anything from a creditor. So you sign a piece of paper that you're liable if anybody comes later on, but you know nobody will, and then you close it. So it doesn't cost you anything. You don't need to involve a lawyer. So even as it is easy to set up, costs 600 crowns, it's also easy to close it down again. So I think very interesting. We talked shortly about IP. I'll just mention one thing on that. If the IP is down here, and you guys' IP is going to be here, right? Just consider, let's say you're going into Germany, or you're doing something, or you're having a big client. If the project has the risk we talked about, remember that this company could go bankrupt, and then the IP could be in danger, right? So what we usually do if there's a high risk, we could make a sales company. And the sales company could have the contract with the big client. And then if everything went wrong, the IP would still be up here. The sales company would be leasing the IP or paying a fee for the IP. You need to have arm's length transactions, but it would be this company that would go bankrupt and there would be no IP in that company. So if it's high risk, getting other entities, maybe in other countries, is a good way to protect the IP. So we have a few questions. I'll start with you.
Yeah, okay. Our company, we have a holding, APS, together, the 3 of us.
The 3 of you. So you are 3 people with 1 holding company.
Yeah, exactly. Could you say that we should change that?
Well, it's much better than if the 3 of you just owned the operational company. So that's good. On the other hand, let's say one of you has to leave and he just wants, let's say he gets 500,000 crowns and he says, and I want to buy a sports car for 500,000 crowns. The problem is, having the common holding company, you cannot say this guy gets the full dividend and these guys get nothing. That's complicated because you have to treat all the stockholders in this company equally, right? What we can do is we can do a split of your company in a tax-free split of the company. So we could create from this company new holding companies. But if we do that tax-free, the Danish 3-year rule would apply. And there would be some lawyer work involved in this. And that would mean that for 3 years, you would not be able to sell your shares without a tax at this level. Does that make sense? Now, if your company is absolutely nothing worth today, then you can just do the taxable split right away. But it depends on if the IP is valued at almost nothing. So if you have a good idea and if already there is investor interest, unfortunately, if you were going to split, you would have to do this 3 years. On the other hand, I would say sometime down the road, if you sold this or if it just became very valuable, you would do the split at some time. Now that you are in the situation, I would say maybe it's okay to wait 1-2 years, see if it becomes a success, and then do the split at that time, because it's a cost, and if you're not a success, then it's a little bit of a waste, right? But I actually recommend, now that we have the IVSs, that if you really believe the idea is good, probably the 3 holding companies would have been okay, because the way you would do it with the annual reports is that 1 time a year, you would say 1 operational company, 3 holding companies. Okay, I hate accounting, so you get 6 bottles of wine and you do that crap, or we have a friend, or we pay an accountant without audit, and it's not a big hassle to get it done. On the other hand, if it's a success, then you have the most optimal structure. So it's not a big problem for you, and it's great that you have the holding company. But if it, and I mean, it's not a bad case scenario that you become very wealthy. Do we agree? So it's only in the good case that everything turns out very well, then you'll have to deal with this. And it's not a big problem, but it will put some restraints, especially if some of you want everything for yourself, and some of you want to reinvest and don't want stuff out. Does that make sense? Yeah. So that's a problem with sharing a holding company, is if you have different interests, then it is a problem. And then you might be forced to do the split later on anyway. So, okay? You had a question?
In relation to the sales company, if we go into different markets,
yes.
Will you then divide, like have two sales companies, for instance, because they're so different?
A Danish company can make a branch in other countries, and other countries' companies usually can make branches in Denmark. So what is a branch? A branch is the same company operating in other countries. Some countries in the world demand that you have a local company. But in Denmark, for instance, a lot of EU companies don't have a company in Denmark. They just operate in a Dutch BV or German GmbH. They just operate in Denmark as a branch. The point is that a Danish company cannot go bankrupt, right? Because it's Siemens AG that is operating in Denmark or something like that. So generally, actually, many companies prefer to make subsidiaries, new companies in other countries. And the reason why I think it is a good idea is if you have a branch, it's quite complicated tax-wise to sell, something that's inside the company and take it out without explaining too much. Whereas if you have a subsidiary in Sweden, a Swedish Aktiebolag, AB, then you just say, okay, so I can sell the Swedish company. I just cut the strings and I can get a tax-free gain from selling the company. So many groups will choose from the risk that they can let the subsidiary go bankrupt, and from the ease of selling, for instance, or getting another investor. Many companies will choose to have individual subsidiaries, but you can use branches. I think for most of you guys, the home market or whatever market you decide on is the relevant one. Maybe one more country than Denmark is relevant early on. And then usually you would create a subsidiary. And if I ever went to the US, I would always create a subsidiary because you get sued for everything in America. So going bankrupt is probably pretty possible. And then having a sales company without the IP working in the US just seems very attractive because let them sue it, it'll just go bankrupt, right? We'll make another one. So, no, I mean, bankruptcy is very negative if you use it to cheat the creditors, but it's very positive if it protects some IP from some crazy lawyers that just, want to sue you. Then it's quite nice to have that option, right? So, don't see bankruptcy as, a very negative thing. It's sort of an escape hatch or a catapult seat or something like that that can actually be very, very helpful in certain circumstances. Okay? Do we have any more questions? So it wasn't a lot about financing. It was a lot about corporate structure, the point of having a limited liability company, the point of having holding structures. I hope you got the point. I think it's not very complicated. I think the main thing for most of you guys' teams is, as you guys have also used a lot of time on, discussing how many percentages do we get, how is the structure done, and then just making sure that we don't have people that are running around just, a few persons up here trying to supply Novo Nordisk with something, making an error or problem. They're personally liable and they don't know who owns what. Somebody runs away with it. I mean, there's a lot of advantages, not of making a company early on, but of making it at the right time, because it gives a lot of problems if you wait too long. So thank you very much, and I'll have my business cards. All of you that are in the program are very welcome to book me for a meeting at my office, or it could be here at DTU. So feel free to do that, and thank you.
Thank you very much, Morten.
Oh, thank you.
Small gift.
Thank you.
Present.
Thank you.
Thank you again.